Right. We are going to discuss out here a small concept called production accounting. It's a part of your unit costing chapter, and it's a very simple concept, and we will just do one question. So I thought I'll explain it to you here. First, we will see what is cost sheet and how production accounting is different. Production account is different from cost sheet. Well, basically, let's start with the meaning of the same. Cost sheet is a document that provides for all costs incurred by company in production of a product during a particular period. We have already prepared cost sheet, so you know what cost sheet is. It can be, if it is per unit, if you have one more column called per unit, that means for one particular unit of production, you will know how much we have spent. You will know the entire cost of how much you have spent and also how much we have produced, how much is our closing stock, all these things in units or tons as well, along with the cost. That is your cost sheet. So it provides all cost incurred by company in production of a product during a particular period of time. Now, what is production account then? It's a T-shaped account. We are coming back, or we are going back to final accounts. T-shaped account that combines features of cost sheet and trading and profit and loss account. Now, the next one is cost sheet is a statement. We've already solved it, how we write it. Direct cost and then prime cost. Along with that, we keep adding. While this is a T-shaped account, it's a ledger account basically. You'll have debit side and credit side of the accounts. And it indicates details of production of a specific period. This has cost of any process, contract services, individual accounts, everything you can use production account for. Time of preparation is before production. You can make it before or after production. Generally, it is before production because to know how much we have to shell out or to know what our estimated profit is, etc. This is generally done after production. And comparison between one period and another period is possible out here in cost sheet, while in production account it's not possible because cost sheet is prepared on budgeted amounts as well. Actual and estimated figures means we are just like planning it for future. With cost sheet, we can plan it for future also and find out. So that is basically called as actual and estimated figure. While this happens after production and hence it's based only on actual figures. What actually happened, what is the production, how much of amount you have spent, that is what production account shows us. Now here it does not follow double entry system of accountancy because there's no debit, there's no credit, nothing like that, and we're just preparing a statement, that's it. And many of the financial terms we don't take into account for cost sheet at all. While coming to production account, it follows the rule of double entry system of accounting. We have already said that it's a ledger account. Now, classification of expenses. Expenses are not classified. If we know selling overheads, etc., all these things are there. Expenses are classified, the meaning which what to charge under factory, what to charge under office overheads, or what to charge in P&L, what to charge in trading, and what to charge in production accounts. So that way it is classified. Tenders and quotations are something that which we will be seeing in coming classes, but for now you understand that it's helpful. If it's a cost sheet, it is helpful in submission of tenders and quotations, while production account does not really play any role in submission of tender and quotations. So that is it about the differences, what we are going to do, like production cost sheet and production account, how the, so if you actually see, and what I'm going to discuss right now is performa of it, there isn't actually a lot of difference between the two. So this says it's a performa of production accountancy or production account. It's a T-shaped account, and this is your debit side and this is your credit side. This is your credit side. All right. Now in production account, what is the first thing? See, you have all this cost, like cost sheet only, you have prime cost, then you have cost of goods manufactured. Till here, you will be familiar with this, right? Till here, it is more or less, you know, if you remember, you have already studied this in semester one, first semester. If you refresh your memory, it was called as manufacturing account. In final accounts, you would have had a question called manufacturing account. Make manufacturing account, trading and profit and loss account, and balance sheet, it said. So production account is more or less your manufacturing account till here, and followed by, from here, pay attention, when you're doing, you will actually see that you're doing nothing else but your trading profit and loss account itself. From here till here, it is manufacturing cost, etc. So what are they? Direct material, direct labor, and direct expenditure. All direct related cost will be taken here. Finally, you will get prime cost. That prime cost will be brought down, and you will add opening work in progress to it and factory or works overhead cost. That's your direct factory, indirect factory cost. And on the credit side, you have closing work in progress, sale of scrap, if any. Instead of deducting it from here, we are writing it on the credit side. Cost sheet may we used to deduct it because we don't have debit side and credit side. So instead of deducting from here, we are writing it on the credit side. By sale of scrap, it's an income. So this is an accountancy ledger. Production account is a nominal account, hence income will be shown on the credit side. And finally, the balancing figure that you get is cost of goods manufactured, which will again brought down. From here onwards, I told you your trading account starts. So trading account, finished goods always will appear in your trading account. You're ready to sell it. That's the meaning of that, is why your stock of finished goods and closing stock of finished goods will always come in your trading account. So once you bring down cost of manufacturing cost, you add opening stock of finished goods along with it. And on the credit side, income, the biggest income for a concern is its sales. So you will write sales on the credit side and buy closing stock of finished goods. Followed by, you will get the balance as gross profit or gross loss, as however your concern is doing. So gross profit, then again that will be, it's not carried down, it is brought down here. Yeah, it's brought down. And then you have office overheads, selling admin, all indirect. In basically in trading and P&L account and we used to say it as indirect expenditure. But out here, anything that is not related to factory, anything that is related to factory will come here. Works overhead, anything that is not related to factory will come in. That is basically your from your cost sheet, your office overhead, selling and distribution overheads will come here. And finally, we end up with a net profit. So it's more or less the same thing, our cost sheet itself, but in the form of accounts. So keeping this is your performer. I will be sharing this as well in Google Classroom. And let us just quickly do one small problem, right? Prepare a production account from the following particulars. So out here we have raw materials ka opening and closing stock, finished goods opening and closing stock, work in progress opening and closing stock. Along with that, we have purchase of raw materials, direct wages, factory overheads, administration overheads, selling and distribution overheads, and sales given. It's a very, very direct question, and they have asked you to make or find out the net profit. That's it, all right? And let us just, okay, you can go through this, or you can just concentrate on this part, and I will just quickly. Production account, and we are doing, this is not there as a part of the other PDF. This is page number E6. Page number E6, and question 1 says, it's from a different textbook, but this is part of your portion. So I thought, why not complete it this way? The production account, the same thing as cost sheet. We are just going to make it in a T-shaped account form. So this is your debit side and this is your credit side. All right. Rupees, amount, anything you can write. So first one is, what will come? To, you're producing something. So to opening stock of raw materials. I'm just writing it as opening raw materials. And out here, so this is the performer, guys. We'll more or less be following this, right? First one is 20,000. This is your opening stock of raw materials. So I'm writing it as 20,000. And out here, along with opening stock of raw materials, what do you add? Basically here, first step, we are not going to find prime cost. We are going to find out material consumed. So if you remember material consumed, it's opening stock. Plus you will add purchases of raw materials. If you have made any purchases of raw materials, when you check the question, we have purchase of raw material as 17,600. 17,600, and then deduct closing stock of raw materials. So instead of out here, it's a deducting, it's not a statement. So what we can actually do is we can always take closing stock to our credit side. So basically the answer will end up being the same. Closing stock of raw materials are 24,700. 24,700. And now finally the balancing figures, these two together 37,600, and out here again you have 37,600. You may ask, oh, we did not see this step, but if you remember your cost sheet, this is what we started with. So here you will get by material consumed. By material consumed, carried down. We'll get that balance there. So this is going to be a balancing figure is equal to whatever the total is minus 24,700. That is 12,900. So this is the very first thing that we found out. And after which you will bring this balance down. So this is just basically direct materials, guys. So far we have just found out direct materials, if you remember. This should be brought down. And just for your reference so that you will understand it better, this is nothing but your direct materials. And what is the amount that we have actually brought down? It is 12,900. Now again, going back to the performer, just one more step we have added, because we have purchase of raw materials and closing stock of raw materials and all that given. So we just added one more step. That's it. And now along with this, we will as usual check for direct labor, direct expenditure. We are going to find prime cost. And after that, we have to direct wages. Direct wages, if you can see here, direct wages are given as 14,000. We don't have direct expenditure given in this question, so we don't have to keep searching for it. 4, 5, 6. So 26,900, and out here your prime cost will also be the same amount. Write it as by prime cost carried down, by prime cost carried down, and you will bring it down to the side, to debit side, to prime cost brought down. Amount is 26,900. Now this is the part where we find out, we add indirect expenditure, indirect factory overhead expenditure. We will add, one second, we will just add indirect factory expenditure here, check for it. So you have two factory overheads. Factory overheads is 7,900. Guys, from here, prime cost plus factory overheads will actually give you cost of production according to cost sheet. But if you have WIP, after finding, that will be your gross works cost, right? And along with that, you will add opening WIP and you will deduct closing WIP. This is what we had done in cost sheet. So out here, there is no concept of gross, gross factory cost and all that. We will directly include to opening WIP. And your opening WIP is 6,200, 6,200. And 200, and instead of deducting closing WIP, we can always write closing WIP on the side. WIP, it is 6,900. And finally, you have, we don't have sale of, here we have sale of scrap, but in this question we don't have sale of scrap, so we need not do that. And you are ending up with cost of goods manufactured. Cost of goods manufactured, it's nothing but cost of production itself, manufactured carried down, and the balance is going to be, just quickly check, this is 41,000, right? 41,000 minus 34,100 is your cost of goods manufactured carried down, or in other words, this is nothing but your cost. Okay, now along with this, so I told you till here is more or less your manufacturing account. From here, whatever we are going to do, it is going to be your trading account. This is going to be your trading account. All right, so that amount first. Brought down is 34,100, and along with this, now trading account, always if you remember your final account, trading account starts with to opening stock of finished goods, to opening stock of finished goods. Once you check what your finished goods are, we have 14,300 here, And then obviously closing stock will come here by closing stock of finished goods. It is 8400. And then we have in trading account another income is sales, or the only income basically is sales. So sales is 56,800. I'm getting the amount from here, 56,800, and then we check again. We are going to tally our or balance our trial balance, cost of trading account. Not trial balance. This is your trading. This is as per this entire thing is production account only, but I'm just trying to relate it with your manufacturing or whatever you have already studied. That is final accounts. So this much is your manufacturing, and this is basically nothing but your trading account, and this is your P&L account, right? 65,200. $48,400. 400. Now that is your gross profit carried down. So after which, first thing you will do is gross profit is brought down 16,800, and then you have you will check for all the other expenditure. We have already taken purchase of raw materials. All those things are already done. Purchase of raw material is done, direct wages is done, factory overheads are done, and also sales. So here we are left with only administration overheads, that is offers related and selling related. We will just quickly write that as well. Administration overheads of 2,600 into and distribution overheads of 3,000. Selling and distribution overheads of 3,000 as well. And I think that's about it. Gross profit, yeah. We have taken all the expenditure, and unlike final accounts, a good thing is we don't have to prepare, we don't have to show this anywhere else. We don't have to prepare a balance sheet. To net profit, that will be your balancing figure. How much is that? 345. So this 5600 will give you 11,200. That is your net profit of the concern. That's it. That's more or less your production account, and I think this was quite simple to understand. Any doubt, we will clear it in class. So there you go. This is your production account, guys. Basically, it is nothing but material consumed plus wages. You're getting prime cost plus factory overheads. You would have ideally got your gross work cost, and along with that we added WIP and deducted closing WIP in order to get net works cost. So instead of that, we call it as cost of goods manufactured here. Then with cost of goods manufactured, when we add opening stock of finished goods and deduct closing stock, or basically trading account, you will get your gross profit. This is, just think of it as your trading account. It will make it easier. Your gross profit, and after gross profit you add whatever expenditure is remaining, that is your administration and selling alone was remaining, you included that as well, and finally we have got net profit as 11,200. So that's it. This concept is also done. In the next class we will do tender and quotation. Thank you.